bond, of course, you're given a coupon rate, which means you receive those coupon amounts, right? So it's a percentage of the face value. And then calculate the value of the stock and the bond, okay? And you're also given different required returns. This is just another way of saying this is your discount rate, right? When you take the present value, the discount rate for equities or stock is 10%. The discount rate for US bonds is 5%. Okay. So then from there you know, okay, I'll have to take the present value of these future cash flows using that for that and that, those two discount rates. So for a bond, it's very straightforward because usually there's a fixed coupon. And that fixed coupon is simply the coupon rate times the principal amount. So also you need to be mindful, is it paid annually? If it's paid semi-annually, you have to divide it by 2, paid every 6 months, right? So you have to take note of that as well, okay? But you will indicate that. And then your discount rate per period is I, or you can call it still R, right? But whichever, as you use that to discount the cash flows. Until maturity, at which point for bonds you would usually get the face value, like in a way like the principal amount for a loan at the very end as well. Now question for you is, when is the bond priced at par? When you say at par, the price of the bond equals its face value. In our example, 1,000. When does that happen? That the bond price is the same as its face value. It's at par. Any? No? Well, it happens when the coupon rate equals the discount rate. Right? And we'll see this later. So we'll do the bond first, because the bond is a lot more simple than the stock. In fact, out of the 6 marks, you only get 2 marks for the bond pricing. So you get 4 marks for the stock price, and it's a bit more complicated. Okay. So how do you price this bond? So as an exercise, compute for the price of this bond. Anyone? Does anyone have an answer? $1,000. Because just now I said, if the coupon rate equals the discount rate, then the price of the bond should be at par, which is the face value, which is $1,000. So you don't actually even have to compute, because if you know that, you know that it's $1,000 if that's par. But okay, if you need to show your solution, to get those 2 points, right? Then you try and compute it. So 5% coupon, 5% times 1,000. Every year you get $50. And so the first year you get 50, the second year you get 50, but you have to discount it twice. Then the last year you get 50 and the face value of 1,000. Then you discount it for the 3-year time period. And the discount rate, as we said, is 5%. Your coupon rate is also 5%. So no surprises there. You just get 1,000 as the price of the bond, which is at par. Okay. Because the coupon rate is equal to the discount rate, and therefore the bond is priced at par. Okay. So straight away you should know this. this relationship. So don't forget the coupon rate, you multiply that to the face value, and those are the coupon payments you'll be receiving every year. And then the discount rate is the one we use below, right? 1 plus the discount rate to the power of t, the time. All right, so that's the price of the bond. How about the stock? Okay, the stock, well, you have to figure out, and again, it would help if you drew a timeline of the stock, right? So let me show you the timeline, because it's very important that you're very clear about the timeline so that you can value the stock correctly, right? So if you look at the so-called the problem, okay? So US stock and we look at the timeline. So time for 0, 1, 2, 3, and your cash flows are pay a dividend 50 next year, so 50. Then the following year 60. And 3% thereafter. So from here onwards, whatever you have here will grow by 3% onwards, right? So this is your growth rate. So for example, on the third year, you'll have whatever the previous year was, 60, times, it grows by 3%, so 1 plus 3% is 1.03. That would be next year's cash flow. And then the following year is 60 times 1.03 squared, right? And so on, right? So it will just keep growing by 3% every year. So now you have to recognize certain patterns, right? So when you find something with a constant growth, you should know what equation you can use to price this stock from here onwards, okay? And take note, by the way, also your discount rate is 10% for stocks, right? So if you were to compute the price of this stock at time 0, how much your stock is worth, you would discount the future dividends, so 50 divided by 1.1 for the first year, plus 60 divided by 1.1 squared, right, for the second year, plus you need to recognize that this is a constant growth formula, right? So let's go to here first. We'll take a little detour to remind you, okay, generally speaking, for stocks, you just take all the future dividends forever until infinity. How much will this stock pay you, right? Now, of course, this is impractical, but there's no way for you to know how much would the dividends be for the next 100 years or so if the stock exists, right? And so we find patterns, and we hope we'll make certain assumptions. One assumption is no growth. Let's say it'll pay 60 forever, the same amount, right? And so therefore that is called a perpetuity. Something that pays you the same amount forever, it's called a perpetuity. And the equation for valuing how much is this perpetuity worth today, the price of a perpetuity today is that constant dividend that's paid forever divided by R. Take note, this is not 1 plus R, this is simply R. Okay, so that basically simplifies things a lot, doesn't it? If you assume this stock pays 50 forever, you just take 50 divided by the discount rate, and that's the value of the stock, right? So let's say 50 divided by 0.1, right? So that becomes 500. That's the value of the stock. Now the other, let me just show it to you. So this is the zero growth model, right? Zero growth because constant dividends forever, same amount. You consider it as a perpetuity. Okay? So that's a quick and easy way to value a stock that pays the same amount forever. You just divide it by the discount rate. Okay? Now, you could also assume that they have a constant growth for the dividend, right? Because it's kind of sad if the stock keeps paying just $50 forever, it doesn't grow. So here you assume a constant growth, G, right? So every year, your dividend grows by 1 plus G, right? Let's say 3% in our example. So it'll just keep growing by 3% every year. And the shortcut for that is the price of such a stock will equal dividend divided by the discount rate minus the growth rate. And this is called the Gordon growth model. Okay. So this assumes the stock pays dividend, and this assumes the discount rate is greater than the growth rate. Otherwise, this whole equation will be negative and it won't work. Right? There's no negative stock price. Okay. Right, so going back to, before we go back to the problem, there are stocks that you know the discount, the dividends for the next 2 years, right? You know that they predicted that they will be paying this amount of dividends the next few years. And then thereafter, you may make certain assumptions, right? Maybe you plan to just hold it for 4 years, and then you just assume from 4 years onwards it will keep growing by a constant rate. Right? So this is like the two-step valuation method. You discount its near-term cash flows, then you have some assumption about the cash flows until perpetuity, until forever, right? That from here onwards it will grow by a constant rate. And you have to be very mindful of the time period. So this is the price, the terminal price at time horizon H. So you need the dividend for the next period, and you divide it by R minus G. Because you see here, this is time period 0, and this is the next period's dividend. Right? So it's always that next year's dividend, then you divide it by R minus G. So similarly here, you're also using the next period's dividend. Okay? And that's the terminal price at time H. So whatever you receive at time H, a future cash flow, that value at time H, you also need to discount it, right, for H periods. So then you have to discount it 1 plus R divided by H, because it's something that you received at time period H, right? So you have to still discount that cash flow, okay? All right, so now let's go back to that problem, and this that we've written down here. Right, so what should be the price of this equity, right? So now we said that, maybe I'll use a different color. We know the dividends for the next 2 years. Then we assume, or the problem says, the dividend growth is 3% thereafter. So from the 3rd year onwards, okay? So what we'll do is that this 3rd year we'll use to price at time 2, and then the next year's dividend is 60 times 1.03, right? That's the price at time 2, which grows constant. So you know it's R minus G, right? So this will be 0.1 minus 0.03, right? So this is the dividend at period 3 divided by R minus G. This is the Gordon growth, right? Model. Now, but take note, that is for time period 2. So you have to divide that whole thing, this whole thing, by 1.1, 1 plus R squared, right? Because this is a cash flow for time period 2. So you have to discount it for that time period. Okay. So again, if you were to compute this whole thing, the whole thing, so 50, 60, and this dividend for the time period 3, and you divide it by R minus G, that's the price at time period 2, so you discount it for time period 2. And anyway, the whole thing should be 824.68. Okay. So this part is a little bit tricky, right? Because basically you're using that equation, that the two-step process, right? So you're just discounting the first 2 cash flows, then you're using a Gordon growth for the last to value the terminal price of the stock. Your time period ends at time period 2. Okay. Now, an even shorter version. So you'll see here on the slide over there, we went all the way to time period 2 for the terminal price of the stock. But actually, you can even stop here. So another way is to actually just do the first year dividend, and you know that the second year dividend will grow from here onwards by 3%, right? So you just take the price at time period 1, maybe I'll change this color again. The time period 1 price is equal to the dividend at time period 2, R minus G, because 60 will grow by 3% from then on, right? So you can just take 60, right? And then you divide it by 1, sorry, number 1. R minus G is 0.1 minus 0.03. So this is equal to price at time 1. And since it's the time 1, you just discount it by 1.1, right? Because it's the price at this point, this time period. So it's a shortcut. You don't have to go through to the next period because you already know that 60 will grow by 3%. Okay? So, and you end up with the same number. Right? So, but basically, I would rather just do this because it's shorter. But this first method could be clearer, right? Because you're going all the way to the next period. Okay? So this is the so-called two-step process. And there are 2 ways to compute further. That's when you want to stop. I'll put this over there in case you want to take a closer photo of it. Okay? Alright, so is that clear? So either you can go all the way to the dividend dividend of time period 2, because you know that will grow constantly anyway. So this is the Werner growth model. That's the price at time 1 of something that pays you a dividend that grows constantly at 20%. Okay? And then of course since it's at time 1, you discount it by 1 period. Alright? Okay. Alright. Now, they just still want to continue, and they want to continue this by focusing on the bond, right? And so, what is the duration of the bond? Now, again, if you remember from last month, we talked about duration for the whole bank, right? And the duration of a bank's balance sheet, right? The duration gap. But here we're again focusing on an individual security, the bond, right? And there are 2 types of duration, the Macaulay duration, or simply called duration. So if they just say duration, that's the Macaulay duration, which is the average life of the asset, like a bond. The modified duration is simply the Macaulay duration divided by 1 plus the interest rate. And this is a sensitivity. It tells you how sensitive is the bond price to changes in interest rates. Okay. That's called the modified duration. Now, how to compute the duration? You basically take all the cash flows, discount it, and multiply it by the time, t. So a cash flow received at time 1, you multiply it by 1. Cash flow received at time 2, you multiply it by 2. Right? So, and cash flow times the discount factor is simply its present value, isn't it? So the top part is the present value times t. The bottom part is just the sum of all the present values. Okay. Therefore, another way to express this is this way. So 1, 2, 3, up to time t, those are the time periods at which you receive those cash flows, 1, 2, 3, and so on. You take the present value of that cash flow times the time and divide it by the total present value of all those cash flows, right? So this is kind of like a shorter way of writing this. This shows you more clearly that each cash flow is discounted by 1 divided by 1 plus I to the power of t. This is the discount factor for each of those. But you already know that because you already know how to compute for the present value. So this is a shorter way of expressing it. All right. So assuming a certain annual discount rate, calculate the duration of the U.S. bond. So, basically, this would be the calculation. I'm just going to give it to you because to save time, right? And are the cash flows of the bond, as we saw earlier, right? So 50, 50, 50 plus the face value. And these are the discount factors, 1 divided by 1.1 to the power of t. So this is t here. And then, of course, these are the present values of the cash flows. Then the present value times t, right, for each one. So that's why you can see it's the average life, isn't it? The average life, because it's you're multiplying by t, 2.859 years. So although the bond's maturity is 3 years, its average life is 2.85 because you're receiving cash flows beforehand. You're receiving cash flows earlier than the maturity of 3 years. So its average life is shorter a bit because you're getting cash flows earlier. All right. So describe the factors, what would affect the Macaulay duration? Now, just by looking at this, what are the factors that would increase or decrease your average life? Well, looking back at the equation, right, what would affect your duration? D. Right? So of course, how long is the maturity? Like, how many years does it get you to get paid? Because remember, this is the average life, right? And then, how much cash flows are you receiving earlier? The more cash flows you receive earlier, the shorter your average life will be. And another thing is the discount factor, which is a function of interest rates. So what's the interest rate that you're using to discount those cash flows? So to answer that question, you need to talk about three factors that affect duration. The maturity of a bond increases the duration. So the longer the maturity is, the higher your duration will be, right? Because again, it's an average life, right? But the Macaulay duration decreases with interest rates, right? So the higher the interest rates are, remember the interest rate is in the denominator, the more heavily you're discounting those cash flows, right? And so the duration itself decreases. And the more coupon payments you receive, so the higher those early payments are received, the shorter also your duration will be, right? So that the more payments are received earlier, that kind of weighs in your average life to be sooner, because you're getting funds sooner than later. So these are the three factors. You just need to explain how they affect the Macaulay duration. All right? Oops, okay, so that was supposed to be at 9:30, so I'm really way behind. I'm going so slowly. Okay, so now why so much discussion on duration? What's the big deal? Why do we need to know the duration? Well, the duration is important. Once we know the duration of a bond, we can find out how bond prices will be affected by changes in interest rates. And that's important to us. So if I invest in a bond and interest rates are going up and down, I want to know the duration of my bond, because I want to know how much will my bond price move when interest rates move, right? I want to make sure my investment is still there, right? So if the duration is this 4.47, calculate the approximate percentage change in the value of the bond, right? So if you own bonds, you'd be very concerned about duration, how sensitive it is to changes in interest rates. Okay? Because changes in interest rates you can't control, which is out there. Okay? So how you would compute is the change in the price of your bond is approximately equal to negative duration of that bond times the change in interest rates that is expected, divided by 1 plus I. So if you take this duration and divide it by 1 plus I, that's actually the modified duration. Then you multiply it by the change in interest rate, that will tell you change in the price. All right? So therefore, you just actually apply this equation, right, for that exam question. You're given the duration, 4.47, and you're given the 1 plus I, right? And currently interest rate is 6%. 0.006. And then the change in interest rate is positive 0.5%, right? So if you write it down, it's 0.005. And you will get 0.021, which is basically negative, which means that if interest rates were to increase by 0.5, the price of your bond will decrease by 2.1, because it's negative. That's why it's a decrease. Right? So not good for you if you own the bond. If you own the bond and there's an increase in interest rate, you will lose, well, if it's a 0.5 only increase in interest rate, you will lose 2.1% of the value of your bond investment. Okay? So that's why duration is important. It tells us how much will the price of your bond change. Okay? Alright, so I'll leave this for you to do as homework. It is a similar exam question. You have a stock, well, you have two stocks. You're expected to compute what is the value of those two stocks, right? So that you can have it as your homework. But I'll show you the equations that you need to compute, right? For gamma, it's simply a perpetuity. It pays you the same amount forever. For zeta, it's a two-step process, right? You know, some early dividends, and you make an assumption of the price, the terminal price, based on the assumption of a certain dividend pattern. Alright? Okay, so then your answer will be 50 pounds is how much gamma would be worth, right? It's paying 4 dividend forever, and your discount rate is 8%. Okay? Zeta, you have to be very careful again. You have to write down what are the dividends for the next time periods, and then you also have to write down what is the terminal price. Because remember, this is a two-step process here. What is the terminal price? So that you'll find is the terminal price. Okay. So basically, 88 pounds. Right? So you can just copy the final answer. If you don't want to take a photo, you can copy the final answer and then practice it at home to test yourselves. Right? This was an actual past year exam question. You can practice answering this question. They like the two-step process, right? Because it really gets you thinking. You have to be very clear about the cash flows, when you receive it, when you will discount it, and so on. Right? Okay? Formally derive and explain the dividend discount model. Okay? So basically, you check the subject guide for the math on that. But you need to describe the fact that, you know, the value of a stock is simply the present value of all its future dividends until infinity, until forever, right? But it's, as we said, hard to compute for that. And you don't even know the terminal price. But what it's saying is the price at infinity doesn't really matter, because that will be such a small number. If you discount that terminal price, even not infinity, even 100 years from now, whatever that price is will be very, very tiny if you discount it back, right, for in present value terms. A cash flow at 100 years is like tiny, right? So you kind of just ignore that and just say that the value of a stock is the present value of all its dividends. So you're not really ignoring the final price of the stock, you're just assuming it's close to zero by then, since it's so far in the future. All right? Discuss the limitations of the Gordon growth model. Right? So the one where we assume constant growth, what are the limitations? What are the assumptions in the first place? These all need to be true. First, you're assuming for you to use the Gordon growth model, you assume that the dividends will grow at a constant rate, right? And it will be forever. Okay, so if you remember this previous slide, it assumes the dividends grow at a constant rate, and it uses that model. So for it to work, well, the company has to pay dividends in the first place, right? Otherwise you can't use this model. There are some companies that don't pay dividends, right? Especially those that are growing very fast. So first of all, there has to be some dividends being paid. Second, you're assuming that the dividends will grow at a constant rate forever. Then you have to make sure that the growth rate G is greater than, is less than the required return on equity R. Otherwise, you cannot use this Gordon growth model. Right? Because you will have a negative number in the denominator if G is greater than R. And you can't have a negative stock price. So of course you have to discuss it. This is just an outline of the key points you need to make. All right. Discuss the problems that are likely to be encountered in the valuation of common stock and corporate bonds. So there are several types of exam questions where you're asked to compare the valuation of stocks versus bonds, or government bonds versus corporate bonds versus preferred shares versus common stock, right? So all those different types of securities, they always kind of ask some combination of those, 2 or 3 of them, and you compare how these are valued or what are the problems that you might face when you value them, right? So this is kind of a group of type of exam questions being asked. And so you need to compare the valuation. So fill in the blanks. Which ones are the bonds or corporate bonds? Which ones are, which is preferred, and which one is common stock? So the first one, any guesses? Common stock. Second one? Are you sure? Second one? Preferred stock. And the third? Corporate bond. Yes. It can be government because it says there is default risk. Only companies default. So, common stock pays, it may or may not pay dividend. You don't even know the amount of dividend. So it's very tricky to actually get an accurate valuation. Just make certain assumptions. Okay? And also it gets paid last. Right? So because they're the owners, you don't have to pay them really. Right? Preferred stock, there is a fixed percentage of dividend that's paid. So it's a little bit like a bond, where you kind of know how much dividend is paid. But if the company doesn't have enough funds, it also doesn't need to get paid. again, these are owners. Corporate bonds, on the other hand, are obligations, they're debt. So the company has to pay those coupons, the fixed interest amounts, plus the face value of the very end. But of course, some companies don't do very well. They may default. But at least in terms of cash flows, you know what they are supposed to pay. And they rank higher. They get paid first before any of the equity type of securities. Now also another way to show this is compare it with what are the bonds that are risk-free? Treasuries or government bonds. Right? So in the US they call them treasuries. In general we just call them government bonds. Sovereign bonds are government bonds and corporate bonds, and then preferred stock. You know how much is paid, but may not be paid because it's still a equity, and then common stock. So hopefully this will give you an idea which is the most uncertain. Common stock, right? And of course therefore most difficult to value. The easiest to value would be government bonds. So you're kind of sure that that's how much they'll pay. You can just basically discount those cash flows. All right. So here are some points. Discuss the problems you encounter valuing common stocks and corporate bonds. So both securities, you use present value. Right? Even projects, you use present value. That's the main thing. If there's anything you take away in this finance course, everything you take the present value of to know the value. Right? Present value of their future cash flows. But for stocks, it's harder to value because of uncertainty. You're not so sure how much those dividends are. You're not so sure whether those dividends get paid. And that's why you see stock prices going up and down, right? Whenever people have different perceptions of what the value is, right? Like Tesla stock just within the year fell by 40%, right? So it's like, what does that mean? Is that because their dividend has changed, or do they even pay dividends? Or is it because the discount rate has changed, the risk, or whatever the future potential is has changed? Right? So that's why it's very tricky. Like if you use the Gordon growth model, you can't really be sure whether that's constant growth will happen, correct? Bonds is more sure, but some bonds default. So we have all of this, all of these bonds, right? Like Evergrande bonds, they have all these default issues. Right? So again, the value of the bond may fall significantly. Right? And usually nowadays, the bond price also changes because of changes in interest rates. Right? So when interest rates change, the price of the bond will have to adjust so that the yield on the bond will be correct. Okay? So those are the key points you need to cover there. Okay, so we need to move along more quickly. Sorry. So let's move on to chapter 8. Chapter 8 still continues with the return. So here we're focusing on what should be the correct return that we get on all of these stocks or bonds. Right? What's the correct return? And in finance, it's based on risk. So what should be the correct price of stocks and bonds is determined by how much return you're expecting on those stocks and bonds. And the return is based on the riskiness of that investment. Okay? Right? So you need to to know and understand very well the relationship between risk and return, right? So returns vary according to the risk. The higher the risk of that investment, the higher its return should be, right? Because investors need to be compensated for taking risk. And then the safer that investment will be, the lower the return. So when you look at treasuries, these government bonds, their return is quite low because, again, it's very safe. You're sure to get that amount. Okay. Now, because of risk, you're not so sure about future returns. It's uncertain, right? Sometimes it's high, sometimes it's low. That's the nature. That's why it's risky, right? How do you measure this risk typically? Standard deviation, okay? Which shows you the variation of the price in the future. It goes up and down, you don't know, right? So that you measure it by standard deviation. But the risk of a stock can be split into two types of risks. What are those two types of risks? Specific and market, right? So you can split the kind of risk specific to that company, to that industry, that is specific to that particular stock. But there are risks that all the companies are exposed to, for the whole economy, which we just call market risk. Right? Now, also there are many names. So it's specific, it could be also called unsystematic, or it's also called diversifiable risk, because this unique risk, or it's also called unique risk, or you may also see it called idiosyncratic risk. It's so many names. But basically this is the unsystematic risk that you can diversify away, right? When you have a diversified portfolio. The market risk, or the so-called systematic risk, affects everyone. So you cannot diversify this away, no matter what, right? So basically, you know that the risk can be in two parts. What you try to do as an investor to reduce your risk is to diversify away this specific, unique, unsystematic, diversifiable, idiosyncratic risk. There's so many names for the same thing. Now, so let's now look at expected return, right? So expected return on a single financial security is simply basically something like the average or the weighted average of all its possible returns, right? So in the future, you don't know for sure because of risk what the return will be. It will be 10%, 5%, 20%, who knows? There's a variation of that. But there are certain probabilities. If you know, okay, 50% chance that its return is 10%, 25% chance it might be 5%, another 25% chance it will be 20%, right? So usually though, you don't know this. So what people will do is they'll look at the past. And they'll look at previous returns in the past, and they'll take the average, historical average, and that would be the same as their expected return for the future. So they're just kind of using old data, hopefully to predict the future. Now, how do you measure the risk? As we said earlier, we use the standard deviation. Usually your starting point is the variance, right? So you have to kind of recall in statistics how you compute for the variance. Then you take the square root of that, you'll get the standard deviation, right? Okay, so let's say you have an asset that has two possible returns, R1 and R2 in the future, and you know the probabilities of R1 and R2 occurring. This is their variance. You take the square root of that, that is your standard deviation. So this is just your good old statistics. hopefully they won't really make you compute all this in the exam. I think usually they'll give you that. That's a different subject. You just learn how to compute standard deviations in your statistics already. So usually they'll give you what this is. Okay? They'll either give you a variance or they'll give you a standard deviation. Just be very mindful. If you have variance and your equation meets a standard deviation, you need to get the square root of it. Okay, so you have to just be very careful. Okay, so now the kind of exam question you get here would be that you are given two stocks, for example, U and Y stocks. You're given already the expected return, so thankfully also you don't have to take all those historical averages. And you're given the variance of these two stocks. Okay. Then as an investor, you want to know how much should I put my money in stock U, how much of my money should I put in stock Y. So you form a portfolio with different percentages. Right? So maybe I'll put 30% of my money, let's say I have $100,000. I'll put 30,000 in stock U, 70,000 in stock Y. So I have a 30% and 70% proportion or weight into each stock. Okay. Then you test again, what if I put 75% of my money instead in stock U and 25% in Y, and so on. So or I'll have 50-50, half of my money in stock U, or 100% of my money in stock U, or so on. Right? So for all these different portfolios, you want to know what is your risk and your return. Right? So what you want to compute here is the expected return and standard deviation for this 4 possible combinations, 4 different portfolios. Okay? Now, first we said expected return is simply the weighted average of the expected returns for the individual assets. Right? So for your portfolio, the weights would be how much percentage of your money you're putting in each asset. So let's say in our example, you have 2 assets, stock U and Y, right? So your return on that portfolio is what is the fraction or the percentage you're putting in the first asset, let's say U, and what is the expected return in U? You're given that, right? And the percentage you put in Y and the return on Y. Okay? So basically, simply, this is the weight and this is the return, plus this is the weight times the return, and that would be your expected return for that particular portfolio. Right? But each portfolio have different weights. As we said, you have different possible proportions here. So this are the weights x1, x2, right, for your 4 portfolios. And these are your expected returns. All right? Now, the portfolio variance is a little bit more tricky, right? So the portfolio variance is the weighted average. Again, it depends on the weights that you put in U and Y for each portfolio. But basically, these are the weights, x1 and x2, right? These are variances. You see they're squared. And take note, these are standard deviations. So these are square roots. Right? And so basically, it's a weighted average of the variances of each stock and the covariance between these two. This whole equation here, this part, is the covariance, right? So this is the correlation, and this is the standard deviation of stock 1, and this is the standard deviation of stock 2. Okay. So, so basically, you're supposed to compute for all of these portfolios 1 to 4. I mean, this is basically just kind of repeating that for portfolio 1, 2, 3, and 4, you compute the return and the variance. Okay, so you need to memorize this equation. But basically the weight of stock 1, which is U, weight of stock 2 squared, and their weighted average also of their covariance. Alright? Maybe I'll show you the first one. Just the first, let's see. Okay. So let's look at portfolio 1. What is the expected return on portfolio 1? Okay, so portfolio 1, portfolio 1 has a weightage of 30/70, right? 30 in stock U, so 0.3 times, so we're just using the expected portfolio return, right? Times 9% expected return on stock U, as you can see there in the slide. Just refer to the slide. And then 0.7, 70% you invest in stock Y, which has an expected return of 4%. So what you'll get there is, well, this is 2.7, and then this is 2.8. So what you'll get is 5.5%. So this is your expected return on portfolio 1. The 30/70 one. Now, the more tricky part is what is the portfolio variance for portfolio 1. So again, the weightage for stock U is 30%, so x1 squared times your variance is 15%, right, for stock U. Then the weight on stock Y is 0.7 squared, according to the equation. Then the variance of stock Y is 7%, plus 2 times the two weightages, 0.3 times 0.7 times the correlation between the two securities, it's written up there, is negative 0.4, right? So just look at that slide. So it's actually negative 0.4, and times the standard deviation of 1 and 2. So you have here, right? Standard, so this is the correlation, negative 0.4, then the standard deviation of each one. So you have to take the square root, right, of the variance. So 15% and the square root of 7%, like that. Right? So that's basically applying this equation, the whole thing times 2. Okay. And then, well, if you solve for that, you should get 3.06. Okay, and then of course, if you want to know the standard deviation of the portfolio 1, it's just the square root of 3.06 is 1.75. Let's take the square root. Okay, so that's the same, 5.5, 3.06, and 1.75. Okay. Now the rest, you just keep anymore. But I will give you the answer. But please practice first. I'll just show you the answer here so that you can check against your work. Right? So when you practice, don't look at the answer again. So that you know. Okay? Alright, you've been asked by a friend to explain the modern portfolio theory. What are the key lessons? Okay, since we are short of time, let me just show you. Key lessons are investors mainly look at risk and return, right, when deciding which investments to invest in. Maybe you can now add ESG, because now more investors are looking at sustainability. But for our basic finance class, we just say risk and return. Okay, those are the two main things that investors look at traditionally. And key lesson is investors can reduce portfolio risk by diversification. The reason why they wanted to show you this, wanted to ask you to do this, is that you can see how the variance gets lower depending on the combination that you have. Because remember, they have a negative correlation. So there's a lot of opportunity for diversification, lowering risk. Able to lower the risk by certain combinations. The first one looks good. Okay? So that's another key lesson. By adding different assets to your portfolio, the assets having different low correlations to each other, you're able to reduce portfolio risk. Also, you're only compensated for taking market risk, because investors can get rid of specific risk through diversification. Right? So you're only really compensated for taking market risk. And the goal is to have a very well diversified portfolio so that you get rid of the specific risk. So once your portfolio is so well diversified, you're able to get rid of specific risks. And the good starting point for a well diversified portfolio would be to have the market itself. Right? So you can buy an ETF which has, the whole stock market as its input. Okay. Okay, the system is resetting again. So anyway, now the amount of risk that an investor can take will determine also how much the investor will put into the market portfolio versus the risk-free asset. Okay. And then finally, if you want to get a higher return, you have no choice but to take more risk, because these two are very much linked. Okay. All right, so this is a graphical illustration of how you're able to lower risk. So the standard deviation is a sign of risk and expected return, right? So you're able to, by combining different less than perfectly correlated, so these are your correlations. So the less the correlation is to 1, the less your risk will be for your whole portfolio. It goes towards the left, and yet you're able to get good returns. So this demonstrates that if you are able to even get 2 that's totally negatively correlated, you can get even 0 risk, right, down here, the risk-free rate. I think I'll pause here first, let's take a quick break before we continue.